In my opinion, the way that a lot of people seem to talk about options on the internet just seems wrong to me. Like people think, oh, maybe I can learn options trading and get good at it and then make money and generate income through options trading. And I want to just clarify a few wrong ideas that I think that people have. So just as an example, I looked up option trading on YouTube and you'll see a lot of stuff like this one. Options trading in 10 minutes. How to make 1,000 a day for beginners only. As if a beginner could just come in and just start trading options and make $1,000 in 10 minutes. I mean, this thumbnail literally in the center of it says in 10 minutes just make $1,000 a day. Like it's kind of ridiculous. It does make me want to click on it and watch this, however. So I think the thing that people are not really understanding is that options are actually a zero-sum game. They're basically like, imagine if you went to a poker table and it was you and one other player, and there was a dealer there who was dealing the cards for you and the other person. Now, you both brought money to the table and put it on the table. However, the amount of money on the table is not going to grow at all. It's going to stay the same. And then whatever one of you loses, the other person is going to gain. That's how options work for the most part. It's pretty much zero sum. However, there's something that makes it even worse than that. So if I look at an actual brokerage account, we can see I'm just looking at options on NVIDIA. Don't worry too much. There's a lot of numbers here, I understand. Let's say we look at call options on a strike price of $130. Don't worry too much about how any of this works yet. So let's say that we wanted to buy this. We would have to buy at the ask of this 1075 right here. Now each option is actually on 100 shares, so this would actually cost us this value times 100, so it would be $1,075 if we wanted to buy it. However, if we wanted to sell this option, it would cost us 10 times this value, so we could sell it for $1,065. So what does that mean? We can only sell it for $10 less than what we could have bought it for. Now that's the bid-ask spread. So the market maker can make the difference between these two, but us as the trader, we're losing $10. If we just bought this and then sold it right away, we lose $10. So it's not really a zero-sum game because there's this cost in the bid-ask spread. Also, even the cheaper brokers will have commissions on options. So even with a cheap one like Interactive Brokers, there's still a minimum per order fee of $1 per option. So then we're losing money there too. So instead of this being a zero-sum game with a 50-50 probability of being profitable, it's really going to be less than that. It might be something like 48% probability of being profitable. Now compare this to stocks, like buying stocks. Stocks typically have an expected return each year of like 7% or 8%, which means that let's say we went and played poker, we all showed up at the table, we brought our own money, but every year, like another 7 or 8% money is added to the table that we're all fighting over. That makes it a lot more easier to end up profitable because there is that inherent growth. It's not a zero-sum game with stocks. So how likely are you to be profitable with trading options if that's all you're doing is trading options? Well, I've generated this image that shows, assuming that we have a 48% probability of being profitable, because it would be the 50% that would be that zero-sum probability. Then we apply the effects of the bid-ask spread and the commissions and say then after that we only have a 48% chance of being profitable. You'll see that our probability of making money would be starting at about 48%. So if we only do one trade, we have like a 48% chance of being profitable. However, if we do two, let's say, then we need both to hit. Both would need to be successful for us to be profitable, which would basically be 48% times 48%. Now, once we go back to 3 trades, it becomes more easy because we only need 2 out of the 3 to basically be profitable. But what we'll see is the long-term trend is that the more trades we make, where each one only has a 48% probability of being profitable, the less likely we are to end up profitable in the long run. So we see that now this percentage down here, once we've made like 100 trades, has only like a 33% chance or 32% 50% chance or something of being profitable. So people that think they're just going to be day traders by trading options, actually the more they trade, the less likely they are to end up ever becoming profitable. So does that mean that no one should ever trade options? No, that's actually not what it means. So a lot of financial institutions that understand this math, like big banks, they actually enter positions in options. But options are usually used as a way to pair with other strategies, as a way to mitigate risk or a way to generate some sort of income. And so it actually can be smart to use options if you can pair them with the correct position. Like there's something called a protective put, where you can own a stock and then pair it with a long put option or owning a put option to protect yourself from the downside risk. Or a covered call, where you own the stock and then you sell a call to generate more income, but you're protected from the downside because you own the stock. So there's a lot of different ways that people can go about still being profitable even with options in their portfolio.